Proud supporters of Africa this week. Engine, with us, you are number one.
Hello and welcome to this edition of Africa This Week, your wrap of what happened across the continent. I'm Mashudu Masuta. Well, in the program today, we look at Libya's oil sector and assess sovereign risk in the country. Then we discuss development strategies and investment with two high-profile visitors to Africa this week. The chairman of Libya's newly founded National Oil Corporation has said Libya's oil production will begin within weeks and reach full pre-war output within 15 months. Libya was producing 1.6 million barrels per day before an uprising began. Jan Randolph, head of sovereign risk at IHS Global Insights, helped us assess the situation.
Well, where are they at the moment? They used to produce 1.6 million barrels a day, about 2% of the global supply, but that's down to less than 100,000 barrels. That kind of collapse is mirrored in the economy. The economy was at its peak, 2008, $95 billion. It's now less than half that size. So the economy has contracted by over half, and certainly more than mirrored that in oil and gas production. But having said that, the infrastructure, by and large, is still in place. Some of the damage could be quickly repaired as long as the security situation is there. They can ramp up a lot of the output and production and exports fairly quickly. We think as long as the security and the politics are right in the next few months, they could get production back up quite quickly within the next 6 to 9 months.
Who will their strategic partners be? Because right now investors looking into the horizon are concerned whether they will honour existing contracts, whether there will be a review of power sharing agreements, and who they'll do business with. We already know that they are quite fed up with the Brazilians and the Chinese for not backing sanctions at the UN against Colonel Gaddafi, and many people see that as indicative of where their biases will lie in terms of investments.
Yeah, I mean, it's very interesting, and these issues are discussed ahead of potential existing investments and future investments. I think given the current situation, I think they'll want to keep most of the contracts in place. They need to get all the oil out as they can get. Having said that, it's true, you know, a new sovereign authority has the right to reopen contracts, and I think this will probably affect new contracts rather than existing ones. And it's certainly the case that the new Transitional Council would be understandably favourably disposed to those that supported them from the outset, and that is, of course, the French and the British, and also the Italians, where they have a longer standing and deeper relationship because the obvious economic complementarity between Italy being a close market and Libya being a close source of energy for Italy.
Let's talk about growing the oil industry. We know that Libya has proven reserves of 1.3 million barrels of oil. Many people say there's a lot more to offer, but under Colonel Gaddafi, he was very cagey about issuing prospecting licenses, really preferring indigenous ownership of oil assets. Will the Transitional Council have a different approach to prospecting?
It's a very good question. I think we've got to take a perspective here. It's only in recent years, since 2003, when sanctions were lifted after Gaddafi renounced weapons of mass destruction, that Western oil companies managed to get some toeholds, and we are talking about toeholds only, into the oil and gas sector. It was very slow and tentative, and there's a lot of potential. Up until then, it was basically off bounds. Libya was under sanctions. The Americans originally were expelled back in 1986-87. So we really are talking about a very closed economy, with most of the oil and gas sectors under the singular oversight of Libyan interests, with only tentative toeholds made over the last few years. There's a lot of potential. And then certainly, you know, Libya is on every oil and gas company's radar. And it is favourable for them because low cost of production, high quality oil, very close to European markets, the infrastructure's already laid down, very small population. These are all positives that Iraq didn't have.
Let's talk about very high quality oil and just educate me here. We know that Libya supplies around 2% of global output. But what makes it so strategic? We're told that they have a variant of sweet crude that doesn't make it difficult to refine, and this is why everybody wants their hands in it. Just tell us about that oil, and once we start seeing Libyan oil on the world markets, how will that influence prices, do you think?
Well, there are three aspects to Libyan oil. You mentioned the low sulfur content. That's always the preferred oil for refiners. It's easier to process, and you produce a higher quality derivative, including kerosene for aircraft. The other aspect of Libyan oil, it's easy to access. There's a low cost of production. In other words, the unit of barrel of oil, the unit of barrel of oil has a low cost element to it, easy and cheap to get out. And thirdly, it's right next door to European markets. The infrastructure, the pipelines have already been laid, so transportation costs are very low. The final issue about whether it will affect the world price or not, at the moment the world market price, we're seeing the wind being taken out of the oil price and the gas price because of the global economic conditions are weakening. We're seeing a weakening in global demand, and they are the overwhelming influences when it comes to oil prices. Whether Libya produces currently 100,000 barrels, or whether it can ramp up to 1.6 million barrels, which is the current invested capacity, will not have any effect on oil prices whatsoever.
And finally, sovereign risk issues for a new government that needs to try to improve on its credit rating, that needs to start borrowing, it needs to reconstruct the country. What do they have to tap into? Because we know that Libya had some sort of a sovereign wealth fund in the Libyan Investment Corporation. They have assets valued at about $60 billion. So there should be some money that they can tap into. Is that enough?
It's very interesting. The sovereign risk angle will look at the balance sheet. Libya's got huge assets. You mentioned foreign exchange reserves, 60 billion, plus gold, 6 billion, sovereign wealth fund, 60 billion. We're talking about over $130 billion worth of assets. And on the debt side, hardly any debt, less than 1 billion. This is an extremely financially strong net creditor nation. They could quickly release a lot of the cash, foreign exchange, to bring in all the imports they need to avert a humanitarian crisis. We're talking about food, fuel, drugs, electricity, water, you name it. They can afford it as long as the new sovereign authority acquires the rights to these sovereign assets, and that's the key point. Once they acquire the rights to these key assets, they will have no problem financing all they need to rehabilitate and kickstart the economy. What they really need further down the line, though, is a return of the immigrants from the migrants from Egypt. Because with such a small population, they were heavily dependent on migrant workers to keep the economy ticking over. And many of them have left, and they need to come back. And further down the road, the Libyan Investment Authority, this was a sovereign wealth fund set up in 2006, 2007. It would be ideally suited to make investment in infrastructure with the two neighbors, Tunisia and Egypt, both part of the Arab Spring, to develop all sorts of trade and cross-border investment. To build mutual advantage regional economic development. So the Libyan Investment Authority can play a very important role here in terms of regional development with two friendly Arab Spring neighbors.
African investment managers gathered in Cape Town this week at an event bringing together institutional and retail investment communities, aiming to equip investors with the toolkit to survive and thrive in tomorrow's world of investment management in Africa. Carl Marais, Director for Africa at Grail Research.
What we're finding is there's a large trend for companies to be looking particularly at the oil-producing countries at the moment. The focus for us at Grail Research, we're doing a lot more. What we're finding is that South African companies have woken up to the opportunity in Africa. So the majority of our work is actually more South African companies moving up through Africa. So for South African companies, the top opportunities are definitely, Nigeria. It's that huge market. We've already got, a very large presence with MTN there and Standard Bank. And Nigeria, it's such a large market, and it's accounting for more than half of, the GDP growth within Africa. So that's become a very attractive market. On top of that, we're finding that companies are taking different approaches to moving up to Africa. So for some, it's a case of initially they're just moving into SADC. It's kind of safe. They, can keep it close to home and they can manage it from here. Some companies are moving beyond SADC, to the next level. They're going to, Zambia, Tanzania, possibly Kenya, where they're finding it easier to go kind of up the English-speaking eastern corridor.
Right.
And then we're finding quite a bit of interest nowadays in West Africa, and I think one of the hotspots at the moment is Ghana with their newfound oil wealth and relative stability.
Yeah. So oil remains the common theme there, but what about the other areas that everybody else is talking about, which is, of course, is retail? I mean, after that McKinsey report, I think it was last year, there's been a lot of talk about Africa's retail opportunities that have been created by the young population across the continent. Are we beginning to see African companies beginning to work up to that opportunity?
Absolutely. I think, the Walmart thing has definitely been a big shake-up for the industry. And what we're finding is a lot more companies in the retail space are concerned that the market is going to change fundamentally. And I think what we're seeing is a lot of companies are wanting Walmart to pull them up through the continent. So that's definitely I think we're looking at very large populations. One of the markets that also gets spoken about a lot is Ethiopia. We're talking 80 million people. Nigeria with their vast population is of course of interest. And then, again, retail, I think it's easiest up the eastern side. The connection of English-speaking countries, I think that seems to be the most attractive and the kind of most common trod route into Africa.
Now, Carl, final question. Now, what kind of pitfalls have you identified in terms of the companies that have gone into Africa? I mean, we all know about the usual problems of political instability and weak regulation, etc. Are we beginning to see some of this being addressed, and in which parts of the continent?
Well, I think the chief pitfall going into Africa is really logistics. I think that a traditional but your business model is fundamentally affected by logistics, and if you can't move your goods around and get them to where you want them at the right time, you have problems with particularly in retail, perishables, goods going out of date, stale. We then have the massive cost in terms of logistics. If you're sending something up to Tanzania, say from South Africa, how many roadblocks is it going to stop at, and how what does that amount to? So there's massive costs on the logistics side, and then other challenges we see is simply I think some companies try to apply kind of a global model, an African model to the entire continent, and Africa really it's not a country, it's a series of distinct markets. There's certain similarities in terms of development levels within regions, but fundamentally each country is very different.
After the break, more stories making headlines this week.